Hey, so what's the difference between an interest rate and an APR, or annual percentage rate? And, you know, I've done some other videos on this in the past, but it's one of my most popular videos, and I keep getting questions, and so I'm going to take another whack at explaining this as simplistically as possible. So your interest rate, and let's just talk about fixed rate loans here. Your interest rate is the rate of interest that you're going to pay over the life of the loan. So if you've got a 15-year loan at 4% interest, it's going to be fixed for that period of time. If you financed $200,000, then you're paying 4% interest on that loan over the life. Never varies, right? Now, your APR is your interest rate that you're going to pay, plus your closing costs. Now, it doesn't matter if the seller pays the closing costs or you pay the buyer, or you as the buyer pays the closing costs. It's still a cost associated with getting a loan that you wouldn't have had to have paid if you would have paid cash for the house. Okay, so interest rate plus closing costs, regardless of who pays them, plus any mortgage insurance. Now, your mortgage insurance can last on FHA loans, it's at least 5 years. On conventional loans, they're going to calculate mortgage insurance on your APR through the date that it would naturally fall off through amortization. That's about 11 or 12 years into your loan, depending on the program that you're on. So they're going to count that mortgage insurance over 12 years because that's an additional cost, of course, you wouldn't have to pay if you paid cash for the home. So interest rate plus mortgage insurance plus closing costs divided out over 30 years is your APR, annual percentage rate. So what people ask me is, they say, well, moving forward into my loan, am I paying the 4% interest rate, or am I paying the 4.5% APR? Or if you have mortgage insurance, it's probably the 5.25 APR. It's, you know, it gets quite a bit higher because you've got that mortgage insurance built in there. And the answer is, don't confuse yourself. You pay closing costs once, whether you pay them or the seller pays them. You pay mortgage insurance a portion of the time that you have that loan until it falls off, and that's a whole nother YouTube video. And you pay the same rate of interest over the length of the loan. So an APR, in the simplest terms, at the end of the loan, if you turn back and said, okay, I paid closing costs, I paid mortgage insurance, I paid that 4% interest rate over the last 30 years or 15 years, what was the total amount as a percentage that I paid for that loan or for the cost of that financing? And that's what an APR is. So hope you folks understand that. I hope that it's clear. It is confusing. And I get questions from first-time homebuyers and seasoned vets alike. So if you have any additional questions, don't hesitate to give me a call. Love to help you with all your home buying needs. Tune in next time. Take care.